the impact of tariffs on prices is complicated because it has to move through all these different layers. One layer, again, is the currency layer, like you mentioned. And if you take a step back, the dollar has been strengthening over the past few months, right? So again, that means that like if you could pay in fewer dollars, but the from a yen perspective, they're still receiving the same amount of yen, so that buffers a bit. The second layer, of course, is that the businesses could just have thinner margins rather than pass it on to the consumer. And the third layer is substitution. Rather than buy that good that has tariffs on it, buy something else, right? Their overall income hasn't increased. You just kind of shift the composition of what you're buying. So tariffs could definitely have an impact on the price level. I'm less confident that it would have an impact on inflation, which is the rate of change rather than the level. But even the price level itself, it's complicated and it's not clear that would happen. My personal belief is that just all this confusion is going to have a negative impact on growth, such that we're not going to be worried about inflation at all. We're going to be worried about economic growth, and I think that's what the market is sniffing out as well, with the declining 10-year yield, as we've been discussing.
So disinflation, not deflation, but disinflation.
Yeah, for sure. I mean, we're doing so many things that are slowing down the economy. We're cutting spending, we're reducing population growth, we're putting up all this business uncertainty. That's going to have an impact on growth.
On that note, what do you think of GDP now? And what I'm talking about specifically for the viewers is the Atlanta Fed has a metric and algorithm where they try to predict what this quarter's GDP is going to be. And historically, it's pretty accurate, not so much at the beginning of the quarter, but as the quarter moves on. And it went from 2.3% roughly at the beginning of last week to the end of the week when the big deficit number came out. It dropped to negative 1.5%. So I actually looked at that live and I was trying to think through, and I'm like, well, maybe it is because of the deficit. Maybe that has something to do with it. I don't know if it has everything to do with it. But even if it is the deficit, there's a reason that's included in GDP, right? If the deficit really didn't matter, then we wouldn't include it into the equation. So what are your thoughts on what's going on with GDP now?
So I think so that seems to be largely due to the sudden surge in imports. A lot of people are afraid that when tariffs come, they don't know what they're going to be paying. And so they're importing as much as they can right now. So the way that GDP is calculated, so we're trying to figure out the amount of goods and services produced in the US. One way to do that is to just add up what everyone is spending, right? One person's, so your spending is someone else's income. So if you add up what everyone is spending, you can have an estimate of all the goods and services produced. However, if your spending goes to pay someone who's manufacturing in China or outside of the US, then that's money that is not actually goes to goods and services in the US. So we got to take that part out. So when models like these, they look at, say, a sudden surge in imports comparing this time from last time, they subtract that out of their estimate for GDP. And so that's impacting it. Now, one thing to keep in mind is that if you're front loading all your imports this quarter, you're going to have fewer imports later on in the year because you already have all you need, right? So I would expect this lower GDP print to be unwound in the coming quarters.
Okay. And just so people kind of get their head around this, when you think about the trade deficit negatively impacting GDP, because what we're trying to do is we're trying to look at the goods and services produced in the United States. So I think an easier way to get your head around it is look at the flip side of that. Let's just assume that we had $150 billion trade surplus. Well, that means that we produced an additional 150 billion on top of what was bought and sold here in the United States. So obviously you would want that included in the GDP number. So if the surplus is included in that number because we're producing so much stuff and we want to make sure that we quantify that, then the opposite would also be true, that we're producing less stuff theoretically. If you see the trade deficit expanding. So I think what you're saying there is, yes, if we saw this long-term trend where the deficit, which I guess we have seen, where the deficit gets bigger and bigger and bigger and bigger, I'm doing this because when you look at a chart, it's negative.
Yeah.
Then it is true that that's not good, a reflection on what's happening in the internal economy. But if you just get one of these one-offs, just because everyone's front loading tariffs, then it'll probably even out next quarter, and it's probably a net wash.
Yeah, that's what I'm thinking right now. So again, these models, they're not well calibrated to have these when they react to these sudden big changes, and so you can get some wacky data.
What do you think the impact would? I think my concern, because I'm in the disinflation camp as well, I think I would change my view if I saw the tariffs substantially impact the global supply chain. Because what I'm doing here is I'm just going back and say, okay, what caused the inflation that we had in 2020 to 2022? What caused that to begin with? Well, it was that you destroy global supply chains and you give everyone quote unquote free money. And that's a quick way to make prices go up. So I think about, okay, I'm in the disinflation camp right now for 2025. How would I quickly move over to the inflation camp? And I think, again, if I saw the tariffs starting to really break down global supply chains, not that they will, but if that's what I saw, and then if you combine that with like a $5,000 Doge dividend, increasing velocity, setting the moral argument aside, then I would say, okay, I'm back in the inflation camp for 2025. What do you think about those two combined things, the Doge dividend and then the possible supply chain interruption with tariffs?
No, exactly right. That sounds like a replay of 2021, right? So I think everyone learned that 2021, big inflation, that's how you lose elections. So I don't think they want to do that. My guess is that, for the supply chain thing, it's hard to say, but my best guess is that, if it does look really serious, I think they'll kind of maybe tune it down a little bit. There's a lot of flexibility there. I'm not too worried about the Doge dividend. I don't think that's going to happen. What does seem like it will happen, though, is that we could have some more tax cuts later on in the year, but they're going to be focused not so much on consumers, so not so much to boost demand, but more focused on businesses to boost supply. So President Trump, I think, being a businessman, he's doing something that I haven't seen other presidents do. That is, he goes everywhere in the world trying to court businesses to come and invest in America, right? He likes to parade, the Masasane and so forth coming to invest hundreds of billions in the US. I think today there's a festival to celebrate increased investment of TSMC. So he understands that if you build factories and supply in the US, right, you can incentivize them by giving them, tax cuts and subsidies, easier regulatory treatment and so forth. So that can boost supply, which is downward pressure on inflation. So I think the spending is going to be more about boosting supply. So I'm not too worried about this demand surge.
Okay, so very low probability there. I know last I checked, if I was looking at the CME, and the probability was actually very low that the Fed drops. I think it was like a 95% probability that they pause at their next meeting. But I didn't check to see what the market is pricing in as far as the rest of 2025. I'm sure you're on top of that. So what was the market pricing in, and has what we've seen over the past couple weeks impacted the market's prediction for how many cuts we'll get?
So we started the year with the market pricing in just one cut in this year. Now it's about two cuts. So what's been happening is that we've had a little bit of turmoil in the markets. Usually when we have the equity market decline, the market would price in more cuts. And we do have slower economic data. So that's where it stands right now. I think we'll get 4 to 6 cuts. Because I think, so I have confidence in Doge. I do think that the tariffs will be disruptive, and I do think we'll have a big tumble in the stock market. And all that put together is going to get us a lot more cuts than the market is pricing in right now. So that's how I'm looking at it for this year.
Why do you think we'll have the stock market decline? Because, and I'm just playing devil's advocate here, because, in the past, I can't remember how long, bad news is good news, Joseph. So if we get seriously, we get bad economic or even softening economic data, not that we have a crash or something, but we have softening economic data. Well, to your point, that increases the probability that the Fed's cutting rates. And everyone knows that when the Fed cuts rates, you got to buy, regardless of valuations or anything. So why wouldn't that make the stock market actually go up?
So there's a sequence of two events, right? You got to get the decline first before you get the rate cuts, and then you can go up. So what I have in mind is the 2018 playbook. In 2018, I don't know if you remember, towards in the fourth quarter, particularly in December, we declined basically every single day. And at that time, the Fed was still telling everyone they would be hiking in 2019, but we just kept declining and declining. And sometime in mid-December, or maybe actually in early January, the Fed was like, "Yeah, this is not good," and so they pivoted, and eventually, they cut rates a couple of times in 2019, and that I believe December 2018 was the bottom for that cycle, and we began to go up. So there's a sequence in this, right? So first we have to get the decline, then we get the cuts, and then we can go back up.
Okay, so that was the taper tantrum. Is that what that?
It was. I think it was. I'm not really sure why people. So there's a lot of different. Okay, there was that
I think
hiccup
that's
in
what
the
they called it.
repo
Maybe.
market back then. There's a lot of. I think part of that was also doing to trade and so forth. We had the active trade wars and so forth going on. So a lot of things happening. One thing that does stick out in my mind is I remember in December of that year, President Trump tweeted out, "Buy the Dow." And that literally was the bottom. It was really funny. So I guess you gotta wait until the president tells you, and then you know what to do.
Yeah. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets. And I will see you in Orlando, May 23rd through the 25th.